Ganz herzlich willkommen zum DUP Digital Business Talk. Wir sprechen heute über Pro Contra, streuen bei der Geldanlage, aber wie? And as we have two English-speaking guests, I'll just continue in English and try to, this is my first job now, to translate the question. Diversification matters, but in how far and how is diversification to be made? I think this is a crucial question and one which is not to discuss in that extent it might need. As you both know, there are many discussions going on these days. It's all about active, passive, or is it growth versus value, or perhaps even good index hugging versus evil index hugging. But the question is, how many equities or papers do I need to have a really diversified portfolio? This is something, at least to my understanding, which, well, people don't speak that often. And I think it's still a very crucial and important question. Certainly, there are many academical pundits out there with smart studies saying, be it 20 or 30 or be it 200, whatever. But I thought, well, being a journalist, it's more interesting to speak to people who do this work in flesh every day. And this is why I'm quite happy to welcome you, Mr. Dr. Martin Dietz, Head of Diversified Strategies with Legal in General, with a very broad diversified portfolio at hand. And on the other side, it's you, Mr. John William Olsen, Manager of the M&G Global Sustainable Paris Aligned Fund with a very focused portfolio. A warm welcome to you as well.
Thank you very much.
Thank you. And perhaps just one more thing, perhaps people might think or wonder, what are you comparing a multi-asset strategy with equities? Yes, that is a bit like, what's the English phrase concerning apple with pears? Nonetheless, the salient point remains, how many papers does one need for diversification? And I think we all agree that diversification matters perhaps most when it comes to investing money. And so without further ado, I just would like to start with a very small elevator pitch. Perhaps Dr. Dietz, if you want to get started, you have 2 minutes. I'll press the start button and you have those 2 minutes to tell me why it's important to have a very focused approach. If you want to go to, I'll start and do the ding.
Yeah, very diversified approach. Now, there's not so many things that we kind of know for sure when it comes to investing. But one thing that we do know is we all want to get very high risk-adjusted returns. And so the risk management is a key part of what we need to do. And risk management means diversifying, getting risk of individual risks, broadening the kind of the bets that we are taking, investing very kind of broadly. And diversification is also a way of managing risks without kind of giving up returns. So that should be the basis of what everybody does. Definitely, it should be what a client, what an underlying investor bases their total portfolio on. And this is where it links, I guess, to the discussion on, well, multi-asset versus a pure equity strategy. Now, the funds that I manage, diversified fund, for example, is a product that's a core portfolio that's trying to get all assets from an investor and then spread that exposure very well. And that's what I think everybody really needs to do. Clearly, for slices of that portfolio that might not apply, but for the total portfolio, diversification and risk management is a must.
Thank you. Now, the other side, the focused approach. What's your view? Once again, I'll press the start button. What is the USP of a focused approach?
I think the starting point of my approach, which is what I can talk about, is not necessarily that it has to be focused. I've been running focused global equity funds since the last 20 years. But the main reason for doing that is because of my starting point, which is to manage money for the long term. I've always been a big believer in trying to create the best possible long-term return adjusted for risk for clients. If that is your starting point, it's my belief that having a focused approach makes sense. We can dig into more why in terms of why I think that matters. But in terms of managing risk, I don't think you need a very broad portfolio to keep diversified. I think there's a difference between managing risk against a benchmark and then managing risk in general. So I think you can have a very diversified portfolio in terms of absolute risk with a relatively limited number of stocks you can take on less absolute risk. That's actually the case on my fund. So the volatility of my fund is less than, say, a broad benchmark. So you're not taking on, as an investor, your risk of losing money or the volatility you're going to see in your investments is actually going to be lower than buying a very broad benchmark. So it's also a matter of perception and what type of risk you're willing to take on.
Yeah. If I may just jump in with an additional question, what about time? How crucial is time for this approach?
I think for me, it's super important. I think as investors in the modern day world, you see all of this volatility and this noise in the market. There's so much information. Having an information bias that you might be able to 20 years ago, I even doubted back then, but say 30 years ago, where you can print out the annual returns, you can get an edge on a company and apply that to the market, is probably less so now because you have a lot of information available. Where I think you can make a difference as an investor is in terms of your investment horizon. So if I can make decisions based on getting the best possible return over the next decade, I think most people, at least most professionals in the market, would have a much shorter term view in terms of what they do. So trying to take advantage of that and buying stocks that I believe in over a very long period of time makes sense. And that means limiting your turnover on the fund. So having a concentrated portfolio with a low turnover puts you in a position to do that. You can have other strategies where broad diversification makes more sense. If you're a value investor, for example, and you're trying to exploit the next 20% up move in a stock, you would have to get in and out of stocks to exploit that, right? And also, if you're running we're probably going to talk about this later as well, if you're running a small cap fund or whatever way you need diversification, you can have plenty of reasons to do that. But I think for this specific long-term investment approach, having a limited number of stocks makes sense.
Thank you. Perhaps before we get started with the more hands-on discussion, one question to you, Dr. Dietz. Have the other style factors like focused or non-focused been forgotten? I mean, in comparison to active, passive, growth, GARP, you name it.
I mean, to be honest, I think the lines between active and passive are becoming quite blurred. So maybe historically there has been active, and that is whatever stock picking, and passive was just tracking a broad index. But then you look at what index funds are doing nowadays and ETFs are doing. They are very specific funds there that target segments of the market, that target a value or kind of a growth factor. There's various ESG strategies. There's different elements in terms of size or industry that you can get exposure to. And all of these are clearly kind of more top-down things. And the choice of these funds will be active, and the implementation is only the passive one. But it goes even further with kind of more thematic strategies, where almost the selection of the securities is more active, but still you wrap it into an index and then you track it passively. So I think this kind of active versus passive discussion is really almost kind of disappearing a bit. And I think what is happening more broadly in markets is everything becomes more top-down focused. I think that is the main thing. Asset allocators, people that move portfolios around, they're more focused on the top-down side, and they've kind of figured out that lots of similar stocks really move very, very, very closely over time, and so the focus has become much more top-down.
Thank you. Make my life quite easy as you insinuate the next question. And how far does certain, I don't want to say popularity matters, but trends, you mentioned that there's a trend moving away from this dichotomy between active and passive, things merging together. So is there, in your work, perhaps John Olsen, you might start also to be found certain swings of popularity be it on the positive side or on the negative side, be it in inflows or outflows? Do you feel something like that?
Yeah, I think the broad-based approaches have tended to outperform over recent years, or at least the ETF approach has tended to outperform a broad range of active managers. And that's been used quite actively in marketing, obviously, for ETF funds. It doesn't mean that all active managers consistently underperform, obviously. So you are going to have, you will be able as an investor to find active investors that manage to outperform over long periods of time. That said, I think in periods where the large stocks in the benchmark, they do really well, especially with the margin that we've seen over the last decade or so with the big tech companies. You would typically see a bias for active investors to be skewed away from the big benchmark names. Yeah. So, and they would buy, mid-cap stocks or whatever to try and pick up some performance there. And if these big locomotives of the market, they keep outperforming by a lot, then you're going to see underperformance. And you've seen that consistently for quite a while now. So I can understand why it's interesting to write articles about it, and also for why investors are choosing, in many cases, to go the sort of the ETF route or the board diversification. That doesn't mean that it necessarily will persist, right? You get big changes in the market. So you say the sort of the fad or I wouldn't call it fashion, but you do get changes in markets that can cause active managers to have a much larger advantage on the broader funds because the stock picking becomes more important, or because the ability for active managers to outperform in certain periods of times, not necessarily just in growth, of course, in value and other things, is much better.
Perhaps a question to both of you. I mentioned when at the beginning of the discussion, the pundits and universities, and they say, well, there's a theoretical way of approaching the diversification effect. Dr. Dietz, perhaps, what would be, when does the sector of over-diversification start? And to you, John Olsen, what is the minimum number of stocks you would recommend, apart from the legal questions that are out there? Perhaps, Dr. Dietz, if you want to get started.
Yeah, I think this, the idea is clearly on diversification. It's not about kind of counting individual stocks, right? Yeah. It's kind of getting different themes, different underlying drivers of whatever the equities, the bonds, whatever you hold in your portfolio together. And so you can't really count it by number of stocks. It's not clear that you need to have 100 or 200. It depends what you do. And so in my case, that is a driver of using a multi-asset approach, right? Because to a certain degree, equities, the standard equities, they're driven by the corporate profit cycle, GDP growth, the business cycle. So that is one big theme that runs through the equity market. That means all of them get their big beta exposure. And then much more important than doing something within the standard equities is to kind of broaden your horizon a little bit, putting things like emerging market debt into a portfolio, trying to get exposure to property markets, which are quite regional markets, right? You can do that maybe through REITs, which look like equities, but are not typically part of what most equity investors do. So I think that is really what we want to do. Look through what drives the underlying exposures, try to get exposure to different long-term drivers of that return, getting some emerging market exposure and not just developed markets, property, I mentioned that, trying to get some returns out of currency markets, commodities. That is a concept that gets diversification in a portfolio and actually helps quite a bit to diversify away from the standard beta.
Thank you. That leads me to the question, broadening the horizon, as you so nicely put it. How does it work in a concentrated portfolio, John William? Is it perhaps not possible to broaden the horizon with a concentrated, with a focused portfolio?
So first of all, running a concentrated portfolio can be many different things. So you can run a very style specific concentrated portfolio where you go all in on a specific thing, and that's what you are selling to your clients, or that's what you're trying to obtain. Or you can have a diversified concentrated portfolio. So you can easily you actually be I'm typically running strategies with 30 to 40 stocks in them, and you can easily get diversification on a stock like that if you're very focused on it. You would tend to diversify your risk on an absolute basis as well as on a relative basis. It's quite difficult to track an index, obviously, with 30 stocks, and it's not what we're trying to do. But you can diversify, right? So and that goes for private investors as well as professional investors. If they are focused on diversifying the actual risk on the fund rather than trying to mimic a benchmark, I think from a return perspective for an investor. So if you want to invest your pension over the next 10 years, that's what you should be focusing on. Trying to find some stocks that can give you some upside for the next 10 years, and then buy different business models with different end markets, some with cyclicality, some without cyclicality, some that's going to put you in a decent position if inflation goes up, some that's going to put you in a different position if something else happens, because you don't know and I don't know. So I think just thinking about diversification and putting in place actual diversification and trying to bring down your risk and not put all of your eggs in the same basket, which is the main idea behind doing it in the first place. And then stop worrying too much about tracking errors and all the other stuff that our industry seems obsessed by. So I think I think that the more basic you bring it down to looking at actual risk, the probably the better.
That's an interesting keyword. Let's look at this year. And what's your view? Do you think is there a danger of I don't want to call it crash, but to a severe downturn? And how do you cope with the risk of this potential downturn if you want to continue, John William?
I would say stay. Like I said, I've been doing this for 20 years. I was a tech analyst during the tech bubble first, right? So I've been through these ups and downs in the markets. I think running a fund where you have to stay 100% invested is what I do. We are selling an equity strategy, so I can't dabble around too much in cash and other things. I just selling equities. Yeah. I think it's very important, at least for me, to stay in a position where I can exploit big fallouts in the market and take advantage of that. If I'm already all in on a specific thing, I'm going to be very dependent on that thing working, like a specific style or whatever. That specific style has been pretty much one way over the last 10 years, right? Into big, stable, high growth companies. It's obviously been very profitable for the ones that have picked that route. Before that period of time, I was investing during that period as well. It was about China, it was about commodities and growth, much more than it was about the compounding and the things that we are thinking about today. And you get these changes and shifts in style over time. Very few people are able to make that adaptation out of something that has been working for 10 years, if it's the complete fund they're talking about. So having a diversification in terms of what's going to work is actually quite healthy, right? So for me to stay balanced on the fund and have some exposure to both, which I tend to focus on the high quality companies because I like companies that can compound and generate returns for you over time. But that doesn't mean you should shy away from cyclicality and other things. So I think that's probably the best answer I can give you. I think you can be diversified on a focused fund, which is what we do, or you can be very all in a style on a diversified fund or on a broad-based fund, right? So you can end up in a scenario where you're going to have long periods of time, whether or not you're focused or not focused, where you're going to underperform the market. And then that's a matter of style and taste, I guess.
Yeah, thank you. Now, you, Dr. Dietz, have all the place or what are the huge choice of assets you can invest your money in. Do you think this year might be very demanding for the investors, be it a downturn, a crash, whatever? And how do you cope with the risk, for example, invest into alternatives, you name it?
Yeah. Well, I mean, for what it's worth, there's always going to be risks around, right? People, if you look through the past, people always had things that they're worried about. We worry about inflation and kind of central banks right now. China is rebalancing its economy, and there's some geopolitical risks. So that's the kind of the known risks that we're looking at right now. There's always the unknown risks.
The dangerous one.
Thought a pandemic kind of strikes. And then the other point is obviously we are in a long stretched bull market, and it started potentially early 2009, or you can say there's this big recovery after the kind of the pandemic, and that to a degree might create some kind of overvaluations now in some pockets of the market. For what it's worth, it's probably the US market that looks the most kind of stretched to us, or the one that obviously has rallied the most. But it's obviously, if there is a correction, it will be quite a bit more wide based. So we look at the risks. It's not our central scenario that there's a big kind of pullback this year. We're still in a kind of an extended recovery. We think growth will be quite good, and central banks kind of cut rates, increase rates, but they do that in a kind of a booming economy. So it's a tail risk. It's something that we're kind of trying to kind of monitor. Now, what are ways to manage this? Well, you can look at which parts of the market you're most concerned about, and which are the ones that actually haven't performed as well, and maybe represent a bit more of a value in your portfolio. And that means our portfolios, or the ones that I manage, might not have nearly as much in the US than market cap would suggest. And they're trying to be a bit more broad-based across different kind of regions, because we might have more concern that the Fed is starting to raise rates quite aggressively, but not kind of other markets. So there's maybe a bit more risk for the US there. And then obviously, clearly being diversified, again, not just between different stocks, but in a very kind of multi-asset way, that will help in particular if we think that kind of pullback, that crisis is maybe driven in, say, the US or in a certain part of the world, and maybe it's more driven by the kind of the corporate profit cycle.
If you look at the past, and keeping your arguments in mind, one always, every now and then, have these phases of all asset or correlation, where in theory, you're absolutely right. Yeah. One should buffer the losses of the other, but in this very crisis, it didn't pan out. What's the answer to that? I mean, can one be even more broadly diversified?
Yeah, no, I think this is clearly a limit to diversification. And that limit to diversification is when markets do what is called kind of risk on, risk off, right? So everything is being sold at the same point in time because people need liquidity, and they sell all of their positions in a relatively indiscriminate way, potentially in a crisis. And we've seen that in the pandemic, and we've seen that in 2008 and 2009, where kind of we saw very similar kind of patterns in markets. Now, this is where I think we as investment professionals need to just accept there are some limits. There are limits to things that we can put into a portfolio through kind of smart construction. And we need to put a little bit of a buffer in when we do some risk management. We can't kind of put things on a knife's edge, because it can always get a bit worse. And these crises have this kind of tendency that everything is correlated. I think there's also a timing element, because that everything is selling off, that risk off environment, that tends to be a very short-term period. And so again, if we can look a little bit further through that crisis, what will come through is that actually we have invested into fundamentally different things, and what people do in a more kind of panic moment, that will get resolved then over time. And so we will get some of these benefits of diversification potentially just with a bit of a lag.
Thank you. You mentioned these panic risk on, risk off mode. How far does the rise of ETF even enforce that environment where people even feel more, say, inclined or tempted to make a very quick risk-off decision? Dr. Dietz, perhaps get started, and then you, John William, join in.
Yeah, I mean, the rise of ETFs is obviously quite kind of stunning, and I think what you refer to is through ETFs we can now trade relatively illiquid asset classes in a more liquid way. Take an asset class view and implement that in a very straightforward and cost-efficient way. An example to that's obviously mentioned typically is high yield. Usually that's a more complex market, lots of small bonds. The liquidity of these bonds might not be that good. So historically, you can't kind of buy and sell them very quickly. But now there's liquid ETFs. And so an asset allocator can form a view on that market and actually trade on it. And what always happens is if you can easily trade something, then it is being traded, and it becomes a bigger part of that risk on, risk off behavior. So yes.
Yeah, John William, the question to you, does this rise of ETFs make your work harder, more tricky, or do you say, no, it's perfectly fine?
Yes, ETFs are going to work as long as the big companies in that ETF are working out. An ETF is basically just a construct, right? So it's how you package what you're selling, and like it has been mentioned, you can package anything in ETF nowadays, and you can sell that. So it's not necessarily the broad-based market ETFs that people usually think about. But if you're looking at the big ETFs, the S&P 500 ETF or the big global MSCI ETFs, they obviously force you into buying the big stocks in the market. There's no selection in terms of what value things have in that ETF that the investors are buying. So they're basically just buying anything that's out there, and that will work has worked for a while. But I think for investors over time, if everybody did it, the markets would stop working. Right? So you need someone to regulate the value of stocks, and you need someone to decide whether or not something is cheap or expensive in the market, or will grow or not grow in the market. So I think the value for active investors is definitely, and I think on to your previous questions about the correction in the market and how to deal with that. We try to not predict anything. We go to great efforts to try and not predict anything in terms of where the markets are going, because we are invested. But if you can react to markets, you can say, one part of the market has done really well. You can feel that behaviorally everyone is flocking towards a specific area and you're long term. Then being contrarian and saying we should probably react to that and move part of our fund. And I'm sure my colleague here will agree with that. Part of my fund, I can move that into something else, and then get the long term upside when people get more excited about that area at some point in time. And you get that ability to balance between the two. And if you do that in a clever way, I believe that you can use that mechanism as well to create a longer term return that can beat just buying anything out there as you would do in ETF.
One other keyword which is absolutely popular these days is sustainability, be it ESG, whatever you name it. And if you go back to the thoughts of Harry Markowitz claiming, don't put all the eggs in one basket, in at least the journalistic way to put it, one could these days say, well, one risk is certainly, for example, reputational risk, and you can buffer that kind of risks thanks to an ESG approach, trying, for example, an oil spillage, things like that, which is certainly detrimental to the stock development. Now, the question is, in what kind of funds is the sustainable approach easily to be implemented? Is it the broadly diversified fund or the focused approach? What's your view? Or doesn't it matter? It's quite easy to to implement it in both ways. Dr. Dietz, if you want to contribute on that.
Yeah, I mean, ESG is always an interesting topic. I think one of the features of ESG is everybody has a different definition of what it is and wants a different amount of it as well, right? And so that starts with something I would call kind of a hygiene factor, the negative selection. There's some things you don't want to be associated with. And it goes all the way to kind of an impact investing approach where you say, I don't focus as much on the risk and return trade-off as on the kind of what does it actually do in a wider societal kind of context. And what I think is definitely these kind of hygiene factor approaches, kind of negative selection approaches that go a bit further, that do what is called tilting. So they increase the weight to the companies that are good and that reduce the weight to the ones that are not so good. All of these are very straightforward in a more index approach. And you don't lose some of the other benefits that you have from a market-wide investment approach. You get the liquidity, you get potentially the kind of the cost efficiency in implementing it, the kind of the diversification of that index. I think clearly if you move further and further into a more kind of impact-focused approach, then clearly that is more an individual selection approach. People disagree, obviously. As I said, what is a good ESG company? There's only so far you potentially can go just using an index approach where you use kind of widely available kind of data and try and crunch them to come up with kind of a rating of the underlying company. So clearly, if the further you go, the further you probably want to take a more qualitative assessment of the firms. And I think that's John William's expertise now, core area, right?
Well, John William, if you want to contribute on that.
Yes, thank you. I obviously agree, and that almost gave me the answer. But yeah, so you can put in place screenings. We actually have internally in M&G, we do have funds that are doing that as well, where it's a broader-based and more diversified approach. In an impact setting, I'm also running a positive impact strategy, or in the Paris-aligned fund that I represent. The need to do very deep research to figure out what to engage on and to figure out how these factors are influencing the future of companies over the long term. I think it's important to be focused, simply to have the scope to do it, right? So if we are, it takes a long time. It's very labor intensive. There's a lot of reporting around it on every company. And also for us to stay long-term invested in some of these companies as major shareholders just makes a difference. I mean, we can communicate with companies over years, and in some cases even decades, to try and see if we can nudge them and push them as well.
Perhaps one question, Dr. Dietz, you struggle a bit to answer, as you also already spoke about that. I'd like to know the optimal diversification. I know you said there is no magic bullet, so no silver bullet, no magical number, but nonetheless, could you give us just a scope where you think this is an optimal diversification?
Yeah. So now I think clearly we don't talk about kind of getting overly exposed to individual stocks, right? So there's some things that clearly we can completely remove that individual risk, and we probably should. We don't have to have exposure to individual stocks. That really drives the risk of the portfolio. I think for the most part, we can get rid of kind of country-specific risks, sector-specific things. Where it really gets more interesting, I guess, is when we try and find things, as I said before, that are not the kind of the standard corporate business cycle. That is where it's actually quite hard to find extra ones. And this is where I think in most funds, you would use whatever you can find in terms of additional diversification. There just isn't enough stuff that is really genuinely rewarded and very different from the standard equity market cycle. So yeah, in some areas, it should be quite easy to get rid of the risk. It's not about a certain number of stocks, really. It's just you can get completely rid of these risks. But the more you move on the total portfolio level, the more you move further up, finding things that are genuinely different from the equities, that's actually quite hard. So I don't think you can easily get a limit there. What you end up doing is you do lots of things in a portfolio which get you some equity market exposure, but at the margin, add a little bit more.
Yeah.
And I don't think you can do too much of these. They're not very effective if you look at them individually. They're marginal. But the idea is you do a lot of these marginal things, lots of marginal gains, and that actually gives you some additional benefit. Now, let me just say what I do not propose. I'm not proposing you buy a big market cap weighted global equity index and a big market cap weighted global bond index. You will have to be quite specific. We will have to find the things that are quite interesting. And so this is still an active approach, trying to find these things. Yeah. I think that's the one that makes the most sense to me and to us. And yeah.
Perhaps let me rephrase the question. How many asset classes would you, I don't want to say advise, but speak of as a good diversification?
Okay. I'm just going to name a few, right? So clearly you want to have
that's fine.
You want to get some property exposure into a portfolio. That can happen through listed vehicles. You want some emerging market exposure. Emerging market debt is a really good diversifier. Then there are real asset things that you might want in a portfolio, some infrastructure exposure, some timberland exposure. Commodities are another of these kind of real assets that help. And then clearly bonds, credit, high yield. Historically, getting bonds in a portfolio helped to reduce some of the equity volatility. Yeah. That's probably not the case anymore now, right? With where yields are a low level and relatively flat curves. But then again, you can try and be a bit more selective there and find markets where you still get more normal yield levels, more normal kind of yield curves. So that to me are the key building blocks that you would want in a portfolio. And then from that onwards, you can go into more niche asset classes. On the equity side, clearly some emerging market equities, maybe some frontier market equities, maybe some small cap in that portfolio. That's kind of the more kind of granular things that help. Maybe you believe that Japanese equities are quite different from the rest of the world, because Japan is quite different if you've been to Japan. So that's the more kind of granular stuff. That's really the fine tuning then.
I'd like to hand the question over to you, John William. What's the optimal diversification, if there is such a thing as the optimal diversification?
I hate to start every answer with that depends, but it really depends on what you're trying to achieve. Are you trying to achieve diversification against a benchmark? Yeah. So a lot of, or are you talking about absolute diversification? You're just trying to minimize your risk, or you're trying to minimize your risk while optimizing your return prospects, right? And I would take as a starting point that the last part is sort of the main objective. I know a lot of people, they still have this relative risk mindset in place because they don't want to underperform the benchmark for too long. If you're a professional investor, that can easily lose your job, or if you're running a pension fund, that can lose you your job. So that's you have to tend to have an eye on that as well. But I'll say both from a relative and absolute point of view, in equities, I would say somewhere between 20 and 40 stocks. You can achieve really good diversification there. I would say I would typically have around 30 stocks on the strategy, and around 75% or 3/4 of the risk would come from stock-specific risk. When that's the case, I might have a tracking error. But if that's the case, that's an indication to me that I'm relatively well diversified. I'm not taking major style risks or sector risks or anything else like that. It's all from the stock picking. So that means that I've actually been able to pick some stocks with very different end markets, with different characteristica, so that the stock picking can come through, which is what, as a stock picker, I think you want to see. So for me, that's a good place to be.
Okay, thank you. And then we have quite a huge array. On the one hand side, someone who says diversification is obtained through putting different asset classes together on a broad scope, and somebody who says, well, no, 30 equities, that's fine. Perhaps a question to both of you, and we're ending the interview, close to end the interview. Do you consider yourself being competitors, or do you think, no, we're doing more or less the same job, but just with a different approach? John William, if you want to get started on that question.
No, I don't know. Everyone trying to provide a return to their clients, I guess, are competing for their money to some extent. But I would guess we wouldn't be meeting a lot of the same clients out there. And there's also going to be different investments for different investors with different temperaments or willingness to take on relative risk or absolute risk. So I think that there's room for everyone. It's obviously important to always, for us, to keep our clients' goals in mind, and then try and create a strategy or a fund that fulfills that need as well, which is part of the job that we have in the financial industry. So I think we can fit into several different categories out there.
Okay, that's the bucket thought in a certain way. Everybody providing a different bucket for different clients. Would you agree on that, Dr. Dietz, or do you say no, we're just doing the job with a different approach?
No, I think I agree with the assessment. I mean, there's different things. People construct their portfolios in a different way, and some clients want want to construct their own portfolio out of individual building blocks. And then clearly there's probably more scope for kind of individual kind of stock picker building blocks in that wider asset class, multi-asset portfolio that maybe they do themselves. Some of them want a single stop shop. They would go to a multi-asset fund. There's also differences in kind of clients' investment beliefs. What do they believe works? And what is their investment horizon, and what is their kind of pricing point as well. And so all of that really segregates clients and makes them ask for different types of products. So the strategies work for different clients. They're probably positioned differently in a client's portfolio as well. So yes, competition, but not, I would say, a direct one, right? There's always a bit of competition to convince clients to, and convince investors to construct their portfolio in a certain way. And there's competition to convince them of our investment beliefs. But I think the investment beliefs of these two strategies are probably quite different, and there will be some investors for one and some for the other. And that's probably healthy as well, right? So that's how prices are being found, and how the kind of the world works, different concepts competing.
I think this is a very conciliatory and kind way of putting things, and makes my life very easy as a moderator. So from my side, many thanks for taking the time. It's been fun discussing with you. I think I learned quite a bit on these approach to the question, be it focused, be it a very broad approach. What is left is just to say many thanks for your time. Stay healthy and enjoy 2022. May it be a very happy and healthy year to you. So once again, many thanks from Hamburg. Bye.